Celestica, CLS. Full valuation case and Monte Carlo simulation by Value and Momentum. Welcome back to the show. Today we're doing a full workup on one company, Celestica. The ticker is CLS. It's a Toronto-based electronics manufacturer, and over the last couple of years, it has become one of the more interesting names tied to the AI build-out. Here's the short version of why it's worth your time. For years, Celestica was a low-margin contract manufacturer. It built other companies' designs. That's a tough business. Thin margins, not much that sets you apart. But the company is moving up the value chain. It's now designing the hardware itself, the racks, the switches, the servers that go into AI data centers. That shift is showing up in the numbers, and the stock has run a long way because of it. So the question for today isn't really, is this a good business? It's becoming a good business. The real question is whether the price already reflects all of that, and then some. That's what we're going to work through. One quick note before we start. This is for information only. It is not investment advice. This audio is taken from the April 7th, 2026 research report, available for free in the Value and Momentum Portfolio Substack archives. Let's start with what the company actually does. What Celestica does. Celestica runs two main segments. The first is Advanced Technology Solutions. That covers aerospace, defense, industrial, and health tech. The second is Connectivity and Cloud Solutions. That's communications and enterprise gear. Inside that second segment is the part that matters most for this story, since it's called Hardware Platform Solutions. Think of it as the design business. Celestica works on the hardware and the software for high-speed networking switches and AI servers. Its customers are big. We're talking original equipment makers, cloud providers, and the hyperscalers. So Celestica isn't a chip maker, but it's a key supplier to the companies building out AI data centers. When they need racks and switches designed and built at scale, Celestica is one of the names they call. Recent news. Let's catch up on what's happened lately, because three things landed in March. First, the big one. On March 16th, Celestica announced a partnership with AMD. The two are co-developing a rack-scale AI platform called Helios. This is the kind of design win the whole thesis depends on, so keep it in mind. We'll come back to it. Second, there's a leadership change. On March 24th, the company said CEO Rob Mionis will also take over as chair of the board. That follows the retirement of Michael Wilson, which takes effect on May 19th. Third, on the analyst side, CIBC trimmed its price target on March 11th. It went from $400 down to $360, but it kept its buy-equivalent rating. So that's a small trim, not a change of heart. The business is getting better, fast. Now let's look at the numbers, because this is where the story gets its energy. Start with the top line. Revenue went from $7.2 billion in 2022 to $7.8 billion in 2023, to $9.6 billion in 2024, to $12.4 billion in 2025. So growth sped up each year, about 8%, then 23%, then 29%. Now here's the part that matters more. Earnings grew faster than sales. Adjusted earnings per share went from $1.91 in 2022 to $6.06 in 2025. That's roughly twice the pace of revenue. In plain terms, the company is getting more profit out of each extra dollar of sales. That's operating leverage. It tells you they're not just chasing growth. They're getting more efficient as they grow. The margins say the same thing. The operating margin nearly doubled in 3 years. It went from about 4.2% in early 2023 to about 7.8% by the end of 2025. Management has called several recent quarters the best in the company's history. That's not a lucky streak. It's a real shift in how they make money, driven by more of that higher margin design work. A big driver here is the design business I mentioned. That hardware platform solutions segment grew 81% in 2025. It now makes up 41% of total revenue. 2 years ago, it was around 20%. So it's roughly doubled its share. That's the mix shift powering the whole turnaround. Now the gross margin is still thin. It's about 13%. That's normal for this kind of manufacturer, but it does mean there's not much room for error. We'll come back to that when we talk about risk. Let's talk about cash, because cash is where you check whether the profits are real. Free cash flow is running a little higher than net income. The ratio is about 1.1. That's a healthy sign. It means the reported earnings are backed by actual cash, not accounting. Management says they've produced positive free cash flow every quarter for more than 5 years, and they raised their 2025 cash flow guidance from $350 million to over $400 million. To put the trend in perspective, free cash flow went from around $200 million in 2023 to over $400 million in 2025. So it roughly doubled in 2 years. That tracks with the earnings growth. No red flags there. The balance sheet is in decent shape too. Net debt to earnings is about 1.25 times. That's modest. And the working capital is run tightly. The cash conversion cycle is 66 days. And inventory turns over about 5 times a year. Both are healthy for this industry. One more detail worth flagging, because it cuts down on risk. Celestica is holding $397 million in customer deposits. That means its clients are paying up front for some of the inventory. That lowers the financial risk, and it tells you those customers are committed. Now, returns on capital. This one's more of a debate. If you use strict accounting rules, the return on invested capital is about 8.5%. The company's cost of capital is around 12.3%. So by that math, returns are below the bar. But management reports an adjusted return of 35.5% because they add back some costs. The strict number is probably too harsh, and the adjusted number is probably too generous. The truth likely sits in the 15 to 20% range. That's still above their cost of capital. It's good. It's just not quite as strong as management implies. And on the equity side, return on equity reached 13.2%, which finally pushed it past their cost of capital. So step back. 3 years ago, this was an average contractor with thin margins. Today, it's a growing designer with expanding margins and returns above its cost of capital. I'd put that transition at about 60 to 70% complete. It's a company in transit, not one that's arrived. The moat, and what could wear it down. Let's talk about durability. How protected is this business? I'll be straight with you. This is not a wide moat company. There's no famous brand, no network effect that makes it untouchable. What it has instead is a set of narrower advantages that are real, but that need constant work. The strongest one is engineering. Most contract manufacturers just build to someone else's spec. Celestica actually co-designs the hardware. Through that hardware platform solutions business, it owns intellectual property for AI racks, switches, and servers. The AMD Helios project is a good example. They're engineering alongside the customer, not just assembling parts. That leads to switching costs. When you're built into a customer's product roadmap that deeply, you can't be swapped out overnight. Moving a complex program to a rival could take 6 to 18 months of testing and requalification. It's a real headache, so customers tend to stay. There's also scale. Celestica has close to 30,000 employees across 16 countries. About 3/4 of its revenue is produced in Asia to keep costs down. And in that aerospace and defense segment, there are legal barriers. You need certifications and long qualification cycles to build that kind of gear. You can't just show up and start. Now the other side. What could wear this moat down? The biggest structural threat is the hyperscalers building their own hardware in-house. Companies like Amazon, Google, and Meta have the money and the engineering talent. They already design their own chips. The next logical step is designing their own rack hardware. Celestica even admits in its filings that it competes with its customers' internal teams. Amazon is already starting down this path. If one big customer pulls a program, the hit to revenue is immediate. Then there's direct competition. Celestica is up against Taiwanese design manufacturers like Quanta and WeWin. They have lower cost structures, and they're bidding for the same AI programs. As AI spending grows, that competition gets tougher. There's also technology risk. Today's advantage is tied to today's AI architecture. If the industry shifts to something new, like optical interconnects, and Celestica isn't leading that change, its designs could date quickly. That's why these partnerships matter. But they have to keep winning them. And here's the one that cuts both ways. Customer concentration. Three customers make up 58% of revenue. On one hand, that creates deep entrenchment. Those relationships are sticky. On the other hand, if one of them slows down or leaves, it's a serious blow. There's no guarantee new business shows up to replace it. Add to that the geography. About 80% of production sits outside North America, so the company is exposed to tariffs and trade tension. We actually saw what that looks like. In early 2025, during a tariff scare, the stock fell to $58. So net it out. I'd call this a narrow to medium moat. The defenses are real, but they require constant investment. The moment Celestica falls behind on technology or loses a key design win, the protection starts to slip. That's the core bet you're making if you own this. The price action. Quick word on the chart, because the swings have been large and the levels matter for entry. Back in April 2024, the stock was around $40. By December, it hit $100. Then it ran up to about $352 in late January 2025 on AI enthusiasm. Then it turned. Between March and April of 2025, on tariff fears, it fell all the way to $58. That's an 83% drop from the peak. Then it recovered just as hard. It climbed back to $363 by November 2025. That's its all-time high. Right now, we're sitting around $292, so we're about 20% below that high. The stock started 2026 near 302, so it's basically flat on the year. It corrected down to 244 in March, recovered about 20%, and now it's consolidating. It's been building a base roughly between 265 and 310 without much conviction above 300. So that's the setup. Let's talk about what it's worth. Valuation, the heart of it. Here's the central tension. At about $292, the stock trades above the base case across every valuation method we use. But it's still inside the range of a bull case. In plain terms, the market is pricing in something like a 70 to 80% chance that everything goes right. Let me put real numbers on that. Start with a discounted cash flow. We ran 3 scenarios. In the bear case, growth slows to about 14% and the cost of capital stays high. That gives you a value around $92 per share. In the base case, revenue grows about 21% a year at a normal cost of capital. That works out to roughly $236 per share. In the bull case, revenue grows about 26% at a lower cost of capital. That pushes the value up to about $395. So at $292, the market is leaning much closer to that bull case than the base case. It's sitting between the fair estimate of $236 and the top-end target of $395. Now, on the surface, the stock looks expensive against peers. On enterprise value to sales, it trades at about a 270% premium to the industry median. But there's a reason. Celestica earns about double the operating margin of a typical competitor. When a company is more profitable than its peers, some premium is fair. The debate is just how much. Depending on how much credit you give it, fair value lands somewhere between $160 and $310. Here's a more flattering way to look at it. Adjust for growth. Earnings are expected to climb from $6.06 in 2025 to about $8.53 in 2026. That's a 41% jump. Revenue is expected to grow about 36% over the same span. So the earnings growth is real. It's coming from more business, not accounting. When you measure price against that growth, the P/E ratio is about 0.84. For a growth stock, anything under 1 is usually considered reasonable. So on a growth-adjusted basis, Celestica is actually the cheapest name in its peer group. Now let's flip the whole thing around. This is the most useful exercise in my view. Instead of guessing the future, let's ask, what does the market already assume? I work backward from today's price to find out. To justify where the stock trades, Celestica needs to grow revenue about 27% a year, every year for the next 5 years. And it needs its margins to keep expanding, from around 9% toward 12%. If that happens, by 2030, the company is doing $41 billion in revenue and generating over $4 billion in free cash flow. That means its cash flow has to grow about 59% a year. That's a tall order. But that is the bull case the market is paying for right now. And here's the catch in the timing. The cash flows are backloaded. The payoff isn't soon. Look at 2026. Free cash flow is barely expected to move. It goes to about $500 million, up from around $425 million today. Why so flat? Because of a $1 billion spending plan. That's capital expenditure, and it's going to eat up almost every extra dollar next year. To put that in scale, Celestica has historically spent about $200 million a year. So this is a five-fold jump. This is the leap of faith in the price. You're betting that $1 billion spent today turns into the programs that throw off $3 to $4 billion of cash flow about 4 years from now. That conversion from spending to cash is the single biggest bet baked into the stock. So where does that leave fair value? The conservative base case says about $236. Today's price of $292 is roughly 19% above that. So on a careful, conservative read, the stock is not a bargain. The recent drop from $350 to $292 made it more interesting, but it hasn't reached value territory yet. Stress testing it with Monte Carlo. To pressure test all this, we ran a simulation. The idea is simple. Instead of picking one growth rate and one margin, you run thousands of possible futures with a wide range of inputs and see how the values stack up. When you blend all those outcomes, the middle estimate for the stock comes out to $263. About two-thirds of the scenarios land between $178 and $348. Now, where does today's price sit in that spread? At about the 60th percentile. In plain English, in 60% of those simulated futures, the company is worth less than today's price. So to do well buying here, you need Celestica to land in the better-than-average outcomes. So let me give you the levels that come out of this. The fair value, the midpoint, is $263. At that price, risk and reward are roughly balanced. The stock looks clearly undervalued around $206. That's the lower quarter of outcomes. At that price, three-quarters of the scenarios say it's worth more than you're paying. And if you want a real margin of safety, you're looking at the low 200s, somewhere between $184 and $210. The takeaway is the same as before. At $292, the market is already pricing in a better-than-average future. It's not impossible, but there's very little room to miss. What Wall Street and the options market are saying. Let's check the other voices in the room because they don't all agree. The analysts are mostly bullish. The targets cluster between $360 and $400. Goldman Sachs is the high mark at $440. RBC is at $400. Barclays is at $391. CIBC and JP Morgan are at $360. Even the two holds, UBS and TD, sit at $350 and $305. So if those targets hold, there's still meaningful upside from here. But the options market tells a more cautious story, and this is the part that should give you pause. On April 6th, there was aggressive bearish positioning. 8 large fast trades hit the April puts at the 295 strike. Together more than $1.1 million. That kind of size and speed usually isn't a simple hedge. It looks like a directional bet that the stock goes lower. There were more bearish bets for the summer at the 240 and 270 levels, and another targeting 220 by September. Now it's not all one-sided. A few days earlier there was bullish buying with call bets for the summer and fall. But the heavy puts landing right before the April earnings report stand out. It looks like some big players are positioned for a downside move into that announcement. What about insiders? The picture there is more about routine than panic. Back in February 2025, with the stock in the low hundreds, the whole leadership team sold. The CEO sold about $54 million in a single day. The finance and operations chiefs each sold 10 to 12 million. We saw the same pattern again in February 2026, with the stock near 300, but it lines up with the annual compensation cycle. Executives get stock awards, then sell a chunk. So it's normal. It's not a signal that they think the stock has peaked. There is one buy worth flagging, though. In October 2025, a director, Laurette Koellner, bought about $2.1 million of shares on the open market. Unlike scheduled selling, an open market purchase that size is usually a genuine signal. Someone on the inside thought there was room to run. The catalyst, April 27th. Now let's bring it all to a point because nearly everything converges on one date. The first quarter earnings report on April 27th. This is set up as a binary event. Here's why. Celestica has a track record to defend. 5 quarters in a row, it has beaten expectations by an average of more than 10%. For this report, the consensus is about $2.03 in earnings on $4 billion in revenue. If the company beats again and raises its full-year guidance, the stock could move toward $340 and up. If it misses, or even just sounds cautious, the price likely falls to test support down in the 240 to 265 range. So at today's price, this isn't a quiet earnings call. It's a fork in the road. The bottom line. Let me pull it all together. Celestica is one of the clearer winners in the AI infrastructure trade. It's not a chip maker, but it's a key partner to the companies building the world's data centers. The business itself is in good shape. Consistent earnings beats, expanding margins, and a new partnership with AMD that gives it a real catalyst. But the price tells a different story. At $292, the market is already pricing in a near-perfect future. To justify it, you have to believe 3 things happen at once. Revenue grows 27% a year through 2030. Margins expand a lot, and that $1 billion investment pays off cleanly. Our base case points to a fair value closer to 236. So at today's price, you're paying up for a lot of what-ifs with no margin of safety. So here's my stance. Hold what you own. Add only on weakness. Don't chase it here. The math backs that up. At 292, the reward versus the risk is only about 1.25 to 1. That's not compelling enough to start a new position. But if the stock pulls back into that 240 to 265 zone, which lines up with both fair value and major support, the ratio improves to nearly 2 to 1. And if it drops toward 240, it gets to about 5 to 1. That's a much better entry. So the simple summary is this. Celestica is a high-quality company at a demanding price. All eyes are on April 27, a strong beat with raised guidance, and it could head back toward its old high of 363. A disappointment, and the market may hand you that 240 to 265 entry zone. Be patient and wait for the better price before putting more money to work. That's the full workup on Celestica. As always, this was for information only, not investment advice. Do your own research and decide what fits your own situation. Thanks for listening. We'll see you next time.